When it comes to achieving financial independence quickly, there is only one metric that really matters, and that's your savings rate. In this video, I'm going to clarify the concept of savings rate, and this is important because your savings rate determines how quickly you will reach financial independence. Once you fully grasp the concept, you can focus on making adjustments in your life to get there faster. Later in this video, I'll show you exactly how to calculate your savings rate, but first we need to define savings rate and define exactly what counts as income, saving, and spending. So I'm going to clear all this up right now so that you can master your savings rate and reach financial independence sooner than you think. Now, your savings rate is the percentage of take-home income that you save, and it can be used to calculate your savings rate for a single month or a single year, or even over multiple years. And as I mentioned, the reason you want to calculate your savings rate is because it determines how soon you can achieve financial independence and how soon you'll be able to retire. If you save 15 to 20% of your income, well, that's pretty good. Pretty good.
Pretty good.
Pretty good if you want a standard retirement. With this plan, you'll work until 65 or so, and if you're lucky, enjoy another 10 or 20 years of healthy, active living. But what if you want to achieve financial independence sooner than that? In that case, you'll need to get more aggressive. To retire in 25 years or less, you should target a savings rate of 35% or more. In other words, live on 65% of your after-tax income. Now, if you want to retire in 7 years, you'll need to find a way to save 75%. You can reach these high savings rates in one of two ways: by spending less or by earning more. And if you can do both, even better. But I think the most effective method is by spending less, because if you earn more but you inflate your lifestyle to match your new higher earnings, you don't increase your savings rate and you don't reach financial independence any faster. So it's important to put a cap on your lifestyle inflation and live below your means, no matter how much you earn. Unlike, say, winning the lottery, the high savings rate method is the way to achieve financial independence that is within your control. It may not be easy, but it really works. The math part is simple and inarguable. Check out this classic post on the topic from Mr. Money Mustache. In it, Mr. Money Mustache explains how your savings rate determines how quickly you can retire. He notes that there is a powerful double effect of cutting an expense from your life. You increase the amount of money you have left over to save and get a higher savings rate, and you permanently reduce the amount of money you need to save for financial independence. Once you see a chart like this, you realize that it's a choose-your-own adventure. How long do you want to be tied to your job? And while it's difficult for most of us to save 75% of our income, you do have the ability to increase your savings rate to some degree. I'm sure of it. It's not all or nothing. It's a sliding scale, and a lot of this is under your control. So that's all very exciting, but there is still some uncertainty out there when it comes to savings rate because some people aren't clear about what actually defines savings and spending. And we need a clear and consistent definition of these things so that we can accurately measure our savings rate and know more precisely when we can piece out of our job. To put it as simply as possible, your savings is any money you receive that you don't spend. And because you don't spend it, it still belongs to you. It remains part of your net worth. It remains your asset, even if you move it around between different accounts, or if it pays down the principal on an asset that you own, it's still yours. But you don't necessarily have to do anything with the money or move it around at all. Even if it just sits in your checking account, it still counts as savings. Let's imagine that you get paid $6,000 in 1 month as take-home pay. You contribute $1,000 off the top into a 401k. That $1,000 is definitely savings, right? With the rest, you pay bills, buy your necessities, along with a bunch of frivolous crap that you don't need. And at the end of the month, you have $1,000 still sitting in your checking account. That's also part of your savings for that month. It doesn't matter that you didn't transfer it to a savings account or a brokerage or a 401k, or that you didn't invest it at all. It's still in an account that you own. It's yours, and it's part of your net worth because you didn't spend it. So in this scenario, you had $2,000 in savings for the month, $1,000 in the 401k, and $1,000 sitting around in the checking account. Again, your savings is money you receive that you did not spend. So now we know what savings is, but what about spending? We can define spending just as simply as savings. Spending is using money for any purpose that decreases your net worth. This includes necessities like food, shelter, and health insurance, luxuries like vacations and Chipotle burrito bowls, as well as the interest portion on any debt repayment. But then we get into some interesting gray areas like mortgage payment. The mortgage payment is typically made of 4 parts: principal, interest, taxes, and insurance. Now, if we look at these 4 parts, 3 of them count as spending, the ITI part. But the principal part should not be considered spending because it does not decrease your net worth. It's just moving that money around, but it remains part of your net worth. What about a car payment though? Well, this is an even grayer area. Technically, it's the same as a mortgage. The principal part of the payment counts as savings, but does a car count as part of your net worth? I mean, in the strictest sense, it does, but when I calculate my net worth, I choose not to include my car in my list of assets at all because it's a depreciating asset. Just as I don't count my computer or my phone, these things are worth something, but they are worth less and less over time as I use up their useful life. So I don't include a car in my net worth, but hey, your mileage may vary. However, if I had a car loan and was making payments on it, I would include that in my net worth statement as a liability. In that situation, the loan would have a negative impact on my net worth, and therefore, the principal part of each payment I make would count as saving. Each payment chips away at what I owe and increases my net worth by reducing my debt. And once the car is paid off, it's off the books. The loan disappears, but the value of the car is still ignored in my net worth calculation. In addition to knowing what spending is, we need to be able to track it. Now, you could do this manually on a spreadsheet, or you could use a tool such as Personal Capital, which I have a video on here. And once you add all of your accounts, Personal Capital will track your spending for you. When we calculate our savings rate, we also need to know our income, which for this purpose is our take-home income. Income that we directly decide what to do with, either by deferring it into a 401k or other workplace retirement plan, or by receiving it as a paycheck. Let's imagine you receive $75,000 gross income. 20% is taken out for taxes, let's say. That includes Social Security, Medicare, state taxes, all that stuff. And we're going to lump health insurance in here too because it's not part of your take-home pay. So if we start with that $75,000 of gross pay, take out 20% for all that stuff, you're left with $60,000. Let's say over the course of the year, you contribute $8,000 to a 401k and $2,000 to an HSA. That means over the course of the year, your actual paycheck that gets deposited into your account is $50,000. For take-home income, we have that $50,000 in income from the paycheck, and we add back in the 401k and HSA contributions. So that's $60,000 of take-home income. All right, so we've got savings, spending, and take-home income. We're clear on what those things mean. Now let's calculate savings rate. To calculate your savings rate, take your spending for a given period and divide it by your take-home income for the same period. For example, if you received $60,000 and saved $10,000 of that income, that's a 16% savings rate, putting you on track to reach financial independence in 41.5 years. That's a pretty standard plan, but if you could manage to max out a Roth IRA in addition to boost those savings, you could raise that to a 28% savings rate and reach financial independence more than a decade sooner, in just 29.5 years. So once you know your savings rate and track your income and spending over the course of a year, you can get a sense of how quickly you will reach financial independence. You can see that the more you save, the more interesting this becomes, and you can reach financial independence sooner than you think. I hope this gives you some new perspective and motivation on your journey to financial independence. And here's another video that is related to this topic that I think you'll enjoy.